everyone, and welcome today here in the Speaker's Corner at this session organized by the Lighthouse in collaboration with the research group New Finance here at The Hague University of Applied Sciences. The conversation of today is about the question, is a new banking crisis in the making, and what's the influence on digital currencies such as Bitcoin? As you all will know, there has been a lot of turmoil in the financial industry lately, and we're all wondering what is going to happen. A few banks went bankrupt. They were rescued by the Fed and the ECB. But will this be it? Are there more shoes to drop? There's been some rumors about Deutsche Bank, what's going on there. So we're all wondering, when will this end? But equally important is the question, how did this all start? And at the same time, there's been quite an impact on digital currencies such as Bitcoin, which gained about 13%. And we're also wondering about what is the effect on cryptocurrencies. Will this have an influence on the adoption and acceptance? And will digital currencies play a role in the coming years? So a lot of questions, and the person who has the answer to all of these questions is here today with us. So please welcome Professor Martijn van der Linden.
Thank you, Robin. Thank you. Thank you for organizing this. So you invited me a bit more than a week ago, and then we started to organize this. So in a very short term, that's very nice. Because the banking crisis is currently unfolding, and I prepared a presentation of about 30 minutes. So we'll explain about the current banking crisis, and then I will also explain a bit more why it is happening again and again. So looking at those patterns, and then what we can do to prevent those banking crises. So yesterday I published also an article in Dutch on the Follow the Money about the banking crisis. So we argue that we are indeed in a banking crisis, and we were looking how to prevent it in the future. So we also researched, of course, those fallen banks. So there are three groups of fallen banks, the Silvergate and Signature Bank, and what went wrong in their cases. So those banks focused on cryptocurrencies. So, and of course, when FTX, the big crypto exchange, collapsed, they got also problems, and people started to distrust those banks. And there was a kind of classical bank run on those banks, and they collapsed. But these were quite tiny banks, so really small banks, so that was not a real systemic risk. But then the Silicon Valley Bank came. The Silicon Valley Bank is a much larger bank, the 16th largest bank of the United States. It was not systemically relevant or significant before the crisis, but during the crisis that changed. And what happened there? So their business model was quite unique for banks. So they invested mainly in long-term government bonds. And they financed those bonds with deposits, but mostly with uninsured deposits. So deposits, people who have more than $250,000 on the bank account are companies. So they have a lot of rich tech firms, a lot of rich tech entrepreneurs that have had accounts at those banks. But when the interest rates changed last week or last month, then also those government bonds, the value of those bonds decreased. Because when there are bonds with a higher yield on the market, of course, people prefer to buy those kind of bonds instead of those bonds that have been issued years ago with a low interest rate on it. And then people start to distrust the business model of this bank, and there was a world record bank run. So a lot of rich people booked their money away to other banks, and these banks collapsed. And then there was a quite remarkable moment that really rich American billionaires, investors, went on social media and started to ask for state support. And this made, in my view, this bank from a non-systemically relevant bank, it turned it to a systemically relevant bank. So because all attention was on this bank, and when this bank would fail, it would also mean that other smaller banks would not be secure. So this happened in the United States and in Europe, Credit Suisse. So it was not the European Central Bank that saved the bank, but it was the Swiss Central Bank in Europe. That's important to emphasize. So when you look at Credit Suisse, the bank has a long history of scandals. So from they hired detectives to spy former board members, they had all kinds of scandals. They funded Argeos Capital and Greensill Capital that had really bad bookkeeping systems, or so it was just fraud. They invested quite some money in other financial institutions that were active in really doing bad things. And you could argue already for a long time, there have been plenty of articles about that, the internal risk management systems and the management of the bank was not functioning well. And then there was one moment that quite some people today say that it became very important for Credit Suisse. There was a banker in Saudi Arabia, a top banker, who said, we will not buy more shares of Credit Suisse, and then the share price of Credit Suisse collapsed. And also there was a bank run. So a lot of rich clients in Asia and in the Middle East booked their money away from Credit Suisse towards another bank. And that's, I think, the first lesson. So when you look at digital technology, so in the digital age, bank run is much more easy to organize or to happen. So you can easily transfer money from one bank to another bank. And in the past, you had to go to the bank and get your money out. You had to, you need to get your cash money. So you had to change your bank deposit into cash, and today you can just transfer it to another bank. So when we look at the current crisis, then of course, so it is also about political economy. So how do banks react, or states react on collapse of banks? And what happened in those cases? So there was really a fear for contagion. So that means that when there's a problem at one bank, it also there will be problems at other banks. And in the US in particular, so you had the systemically important banks, there's non-systemically important banks, and when you would say Silicon Valley is not systemically important, just let it collapse and people would think at those other non-systemically important banks, so they are unsafe as well. And then they decided, so the Fed and the American government, to insure all depositors at all banks. So systemically relevant or not, all the deposits are insured. Below was 250,000 euro dollar was already insured, but also above that amount. So all deposits insured in the US. And in Switzerland also happened something special. In the weekend, in the Financial Times, it was called the shotgun wedding. So UBS, the largest banks, and the second largest banks, Credit Suisse, UBS took over Credit Suisse, and there was one really big bank there is now in Switzerland, and they agreed a lot of state guarantees. So about 210 billion state guarantees for this big bank that now consists of UBS and Credit Suisse, given by the Swiss state and the Swiss central bank. But then, of course, the question after the financial crisis, we implemented a lot of regulations, a lot of changes in the system, and the promise was no bailouts. And now politicians say this is not a bailout, but when you ask economists and bankers, they say, yeah, it is a bailout. So there is state support, massive state support for private banks. Again. And the promise was it should not happen again. So, and the question, so we don't know yet how big this crisis will become. So if this is the end, or will there be more bank collapses? So unknown at the moment. But for me in my research, the question is, why do banking crises happen again and again? So now we looked at those individual banks. They of course made mistakes, but also when you look at history, there are all the time bank collapses and banking crises. So I defended my PhD thesis last year in 2022, and I started thinking about this topic in 2008, in the former financial crisis. At that time, I worked at ING. The share price of ING collapsed. There was a bank run on ING, and I gradually started to research this topic. How do bank crises happen? How can they be prevented? And especially my focus is on digital technologies. So I look at how digital technologies influence the current banking system, but could also be used to improve the design of the monetary and financial system. And then this search for the right institutions, that's a quote of Hyman Minsky, a famous economist who also did a lot of research into financial instability. So we are looking for the right institutions that cannot fail, or when they fail, that they feel like how other companies feel in a market economy. So, and the main outcome of my thesis are design guidelines, so to give direction to the development, and that is also, of course, part of the solution. So when you look at the system, then there are some key developments. So I already said, so when you look at digital technologies, it's much easier to have a bank run in the digital age than before. A second important thing to keep in your mind is that the amount of bank money compared to the amount of physical cash exploded last decades. So in the Netherlands, so around 1950, 50% of the quantity of money was cash money, so physical money, and 50% was bank money. Today it's about 95 or 93% is bank money, and only 7% is physical cash. And of course, the main advantage of physical cash, you cannot have a bank run on physical cash. It functions always, it cannot collapse. And bankers did quite a good thing, so they digitalized their money and the banking processes. So in the digital age, we are more or less forced to use bank money all the time for digital payments.
How come there's such a difference between the physical and the digital money? How do banks get such an amount of digital money?
I will explain it later.
Okay.
So I will answer it in this presentation. So banks create also money. So on the one hand, they have an incentive to create more money, but also on the other hand, we just prefer digital money in digital age. So we don't want to have a lot of cash money at home, but we prefer to have digital money. And today, the only money available for a broad public is bank money, digital bank money. So I just mentioned this one. So we increasingly use bank money for payments. And this is also why banks and bank money have become more and more important. But the key problem is that bank money is fragile by design. It can always collapse. And I will explain it in more detail why that is the case. So then we have to understand the key features of the current banking system. So in my view, there are key 3 features that make the current banking system unique. And you can also decide to move towards another system. The first feature is that we have a multiple tier system. I will explain it in more detail in a few moments. The second is, so bank money is contractual money. So it's a claim on an institution. It's based on a contract, and you can always go to your bank and ask your money back or transfer to a different bank. So it's based on a contractual relationship. That's really key. And the cash money in my pocket, on the opposite, or a Bitcoin in your digital wallet, it's your ownership. So it's not a claim on an institution. You own it and you can use it. So bank money is contractual money. And then I come also to your question. So how are banks able to create that amount of money? It's a debt-based system, and also that I will explain in a bit more detail. So this multiple tier system, what does it mean? So there are different layers in the system. So at the top of the hierarchy is the central banks, and banks, so ING, Triodos, Rabobank in the Netherlands, have accounts at the central bank. Yes? And at those accounts there are central bank reserves, so it's not the money we use, but they have their own circuit of money. Yeah? Then we, just the normal people, normal businesses, have accounts at banks, and we don't have access to the central bank. So this is really key to keep in your mind. So there are different layers. Banks have a unique position. They have access to the top of the hierarchy, and we, normal people and normal businesses, don't have access to the central bank. That's one. And the second is contractual liquidity. So today we mostly use 2 forms of money. So the bank money, I call it private contractual money, and the physical cash, public inherent money. Something that we agreed that is money, and this is based on that contract. And what is very confusing for most people, why most people think it's exactly the same, is because you can always exchange it on demand at par. So there's no exchange rate. So you can always, for your bank account, €100, you could always back €100 cash, and you can also transfer it to another bank. On the one hand, this is a great thing, so it makes everything smooth, but when there is a financial crisis or a bank run, then people start to distrust this contract, this contractual liquidity. So in case of bank run, people fear that they cannot get their money back and that the exchange rate is not there anymore. So that's what's happening at the moment. Then this debt-based system is also really fundamental. So this is the most simple balance sheet that you can imagine of a bank. Banks possess loans, so our loans, our mortgages are possession of banks. Liquidity reserves can be cash or central bank reserves. And as liabilities, banks have our bank accounts, bank deposits, and other forms of debt and equity. So when you talk about capital ratios of banks, that's the equity. And then, so that's important also to understand. So bank deposits are liabilities of banks. So we can ask the bank to make a payment on our behalf. And how does new money come into circulation? How has it been possible that the amount of private money exploded last decade? Now, so banks create money out of loans. So when I apply for a mortgage at the ING assesses my credit worthiness. So do I have income? Do I have collateral? Do I have a business plan in case of a business? Now, when everything is fine, then me and the bank sign a contract. In Dutch that is called wederzijds schuldervaring, a mutual debt agreement. And then we go to bookkeeping and what is happening. So the bank goes behind the computer and just does the bookkeeping and adds two things to the round balance sheet. So a mortgage, that's for me. So they possess the mortgage, I promise to pay it back. And there's a liability on a bank account, so they create new money for me. So I can ask them to make a payment on my behalf. And my balance sheet expands the other way around. So I own a bank deposit, so I can ask the bank to make a payment on my behalf. And my liability, I promise to pay back the mortgage. So what happened in the Netherlands? So the amount of mortgages given by banks exploded last decades. So banks are creating more and more money out of mortgages and other loans, and this is why this quantity of private bank money really exploded, increased very rapidly. So this is the three main features of the current system. This tired system, so not all economic agents have access to the same layer, contractual liquidity and debt-based. Then we go to systemic financial crisis. So there is a long history of banking crisis. So since the beginning of banking, there have been banking crises. They reoccur. And so in my PhD thesis, I also look at the consequences. So you can say you have direct fiscal costs, so you have to bail out those banks. Then there are indirect fiscal costs. For instance, there's lower unemployment after a financial crisis, and we have to pay those people. A quite important one, mentioned sometimes by economists and central bankers, but by a lot of political scientists. So there's a loss of credibility and legitimacy after the financial crisis. So people start to distrust the system. I think that is still the case after 2008. And this one I added myself, I think, in my PhD thesis. So there's a continuously increasing protecting and constraining of banks by governments. So governments are protecting banks. Now, so I just gave those bailouts as example of Credit Suisse and insuring all deposits in the US. So that is a protection for banks, and on the other end are a lot of constraints, and that are regulations. So we are increasingly telling what banks should do. Yeah? Clear? And this looks very complicated, but I will try to explain it very simply. So what my main argument is in my thesis is, so what banks do, they create contractual money all the time. And sometimes it leads to monetary fragility, so a bank run. So contractual money is a contract between me and the bank, but there's always the risk of a bank run, and when that happens, there is a systemic financial crisis as is currently unfolding. And when that happens, there's a historical pattern, there is state support of the government and the central bank. So they implemented, so the central banks itself is a kind of state support for the private banking system. So in case of a bank run, private banks can borrow more reserves or liquidity of the central bank. Deposit insurance schemes implemented in the 1930s in the US is another private insurance public insurance for private banks. So the state support, the extension of public safety nets on the one hand, and on the other hand, an increasing amount of regulation. So higher capital ratios, rules about bonuses. So they lead to thousands of pages of regulation. But the main problem with all those safety nets and those regulations is that they create moral hazards. For instance, we say bankers are only allowed to earn $500,000 in the Netherlands. Then they can easily move to London and do their business there. And then we need a new rule to prevent that as well. And so there are many rules. Yeah, you can implement that rule, but then bankers will do something else, and then you need new rules. And this is why this amount of regulation, the complexity of regulation is all the time increasing. So there is risk-taking all the time. And there are all the time new forms of contractual liquidity. And this is shadow banking. That was 2008. I will not explain it. So banks also invent new forms of money that are also fragile. And this is a process that is happening all the time. So you can also argue, so the current crisis is just a repetition of the same historical process. So we see monetary fragility, bank run, systemic financial crisis, state support, and then we quite likely extend safety nets and more regulations. Yes? But if you look from a systemic perspective, this is really questionable. So if you look at this protective constraint, what the consequences are in the long run is that there's a lack of competition in those markets. So in the Netherlands, this is a really easy to understand example. We have 3 big banks. After the financial crisis, almost nothing happened. One new bank has been established, the Bank by Ali Nicknam. But there's not more competition. So although most people say those banks do not perform very well, there are no new banks or no better business models. So those entry barriers are really high. So if you want to establish a bank today in the Netherlands, you need a lot of legal schoolers who can help you, compliance officers, because otherwise you don't understand all the regulation. And if you look at this regulation, so in banks, in 2008, 4% of bankers worked in compliance and risk departments. Today it's about 20%. And also at the side of the regulators, of course, more and more people are working in departments that check if banks are fulfilling all the regulations. So there's an increasing amount of costs are made in regulation and compliance. And so that's really questionable from an economic, is that efficient? Can those people, is it not better when they do something more useful? And also from a systemic perspective, so there is less market discipline. So in a way, so also your bank money, your bank deposit is an investment in a bank, so you can lose it. That's also taking part. And this example in the US of these rich entrepreneurs that start to cry or scream for public support is, I think, a very good example. So that is market discipline. They should question this bank. They should have questioned this bank themselves. They are investors in this bank, but they are not doing it. So there is no market discipline. And what we also see is that financial risk management is increasingly done by all kind of public institutions. So the central bank, but in the case of Credit Suisse also, the Swiss government guaranteed all kind of portfolios of Credit Suisse. So, and then I think this is also the conclusion of my PhD thesis. So when you look at the problem analysis, so the banking system at the core of our marketing economies does not operate in accordance with its rules. So this is quite strange. And a quite fundamental mistake in the current system. So as said, so when the last financial crisis happened, then I was working myself at ING, and then gradually I moved into this topic and started to write about things. But more people, of course, did it. So after the last financial crisis, it took, I think, 4 to 5 years till people could really propose real alternatives to the current system. So there was a lack of ideas. And last weeks, when you read the Financial Times, for instance, so really mainstream financial newspapers, you see those kinds of articles or opinions. So the first, the unstoppable rise of government rescues. A maximalist culture of bailouts and state support is bloating and thereby destabilizing the global financial system. So this guy is arguing a bit aligned with my analysis. So what they do, all the time you are saving the current system. And in the market economy, the beauty is that bad actors, they fail, and then there is more space for better ideas for new companies. But when you don't do that, then you lose a lot of new ideas, a lot of new productivity. And the second, banks might behave responsibly if treated like adults. The failings of intrusive financial supervision have never been more obvious. And he makes the argument, so the more regulation there is, the less responsible bankers behave. So they just follow the rules and don't think themselves. And last week I had also a call with an economist professor in the US, Larry White. And he said that before deposit insurance schemes that were implemented in the 1930s in the US, the American banks advertised how much capital they had. So they said, we have 30% capital, we are a safe bank. And nowadays, central banks are telling the commercial banks how much capital they must have. So it's in Europe around 8%. And all banks have 8%. And that's the crazy thing. So also for my PhD thesis, I interviewed quite some central bankers, and quite some were really frustrated that commercial banks are exactly doing what they demand from them. So there is no thinking themselves, how risky do I am? How should I cover those risks?
If they have a 8%, how do you call it?
Capital ratio.
Capital, they can make more money, right? And if they feel the people are the ones who have to pay for it.
But here's the question about the long and the short run, of course. So if you want to survive in the long run, then you make in the long run more money. And you see, for instance, the Silicon Valley Bank, the CEO sold on February 27, he sold for 3.6 million shares, $3.6 million in shares. Then the bank collapsed afterwards. So he knew himself that there was a lot of risk in the bank. And if he would have managed the risk better, he would have held those shares and he would have earned in 10 years still money. So, and I think so. This is in all the system. All those protections lead to a kind of, you have to make the profit now, and what happens in the long run, that's more the risk of the government and the supervisor, because when there are real problems, you get bailed out. And those two other ones. So banks are designed to fail, and they do. This is a system that is essential to the functioning of the market economy, but does not operate by its rules. So it's really quite similar to the analysis of my PhD thesis. And the other one, the Silicon Valley Bank fallout makes the case for digital currencies. If we think all deposit must be safe, what is the point of banks? So this is hinting towards a solution. So, and when you look, so what can be done? So I think there are broadly two alternatives. So the first is intensifying this protective constraint. So you say all those private bank deposits, we guarantee them as public institutions. And then we, of course, question, so that's an advantage of banks, but then we really demand from them high capital ratios, more extreme stress tests, and change in liability rules. So we even say there must be stricter rules for banks, and they should behave according to those rules. And the advantage that they have is that we more or less guarantee all their bank deposits. So that's one way to go forward. Another one is separating the public and private domain. So this was already proposed in the 1930s in the US. Then it was called the Chicago Plan for Banking Reform. It became later known as full reserve banking or narrow banking or limited purpose banking. So in the essence, I think the essence is also very easy to understand. You have safe deposit banks or full reserve banks. And what do full reserve banks do? So they have those bank deposits on their balance sheets, but they cover them fully with liquid assets. So that can be cash, that can be central bank reserves or short-term government bonds in some proposal. So it is a full reserve bank, so there is no risk. So in the case there is a run, it's almost fully covered with liquid assets. And the current banking system, so there are quite often long-term assets, so mortgages, those longer-term government bonds. That is attractive, but it brings risk in the business model. But what could be an easier way to move forward is also the digital currency. There's a so-called central bank digital currency, one moment. A central bank digital currency, what is a central bank digital currency? So is that we have a digital variant of cash money. And it can be implemented in two ways. You can, one way is to have a decentralized version so that you can store it in your wallet on your phone. So just like you have physical cash today. And another alternative is that we all have an account at the central bank. And that will just be the end of this layered system. So if we have a central bank and we argue it's a public institution, then why do only private banks have accounts there, or should all people and also non-banks, businesses, be allowed to open their accounts? But then you end this layered system, so there's a quite structural change in the system. And the second part of this proposal would then be, of course, you will still have financial institutions, but they should behave, or they should be disciplined in the market, and that means so they should fund themselves differently. That's the key thing. So what I just showed there, so when you look at the balance sheet of banks, on the right side there's a huge amount of bank deposit. That should not be allowed if you take risk. Then there should be bonds, or more equity, so shares. And what is the main difference? So they don't offer this contractual liquidity. So they offer market liquidity. So if I have a share of ING, you can sell it in the market. And it fluctuates. So if the assets have a lower price, then also the price of those liabilities can drop. And the key thing is, so from a systemic perspective, that those can function without safety nets. So you don't need the central bank of last resort, you don't need deposit insurance schemes and all those things for banks, you don't need anymore. And also with regulation, so nowadays we have this, what is called microprudential regulation, so that you are telling banks what they should do. 8% capital ratio, no bonuses, yes or no. But in this case, so you should go back to the, in my view, the essence of financial regulation. And that's first, transparency, so that you have just transparent market processes. And the second is consumer protection. So when I say give me money and I promise to buy a windmill farm and I go to invest in something different, that you can bring me to the court and that there is a kind of legal procedure. So this is a key thing to discuss. And you had a question?
Yes, I'm curious from the central bank side, what are the central bank reserves backed by, and also in the future, if we get the central bank digital currency, also what will that be backed by?
Yeah, that's a good question. It's a very good question. So this question is, so how should central banks back central bank digital currency? And I think that's important to understand. So also our current cash money is not backed. So it's backed by our productivity. So when there's no production, it doesn't make sense if you have Bitcoin or dollars or euros. When there's when no one is producing, so the productivity is always the ultimate backing of any currency. And here there are several proposals. So when it's really a central bank digital currency, then you still have indeed a balance sheet. So then you would have liabilities, the central bank digital currency, and assets. And then the question is, what is on the asset side? That could be government bonds. That could be an option. But there are also proposals to transform the central bank into a monetary authority. And then you would have a more similarly designed to, in my view, Bitcoin. So Bitcoin does not have a balance sheet, but a ledger. And then you have our names, wallets, and on the other side, non-negative accounts. And this also means, this is also quite fundamental, that you don't have these mutual debt agreements anymore in the money system. So you cannot expand the supply of money by creating money out of loans, but you just have a safe system. So it's more like the cadastre for our houses. So the ownership of our houses are registered in a cadastre. There are all our names and what we possess. That's something that governments could facilitate for the citizens. And then you have more or less a part of your liquidity stored in a digital public safe. Yes? And then the final slide, because there's also in the title, what could be the role of cryptocurrencies? And when you look at cryptocurrencies, I think you should really look at their design. So there are different cryptocurrencies. And when there is a central counterparty, so when there is an institute issuing something, then there's also counterparty risk. I think that's quite clear after the collapse of FTX. So then there is risk, and then, in my view, also their financial regulation should focus on consumer protection and making it transparent. That people know where they invest in, and when there is really fraud, that you can bring people to the court. And those stable coins are, in my view, very similar to what banks do. So they issue coins, so you issue a crypto dollar, and you say, when you come to me, you can also exchange one to one in an other dollar. So there is again contractual liquidity in a new form. So when there are institutions that promise to exchange one form of money one-to-one with no exchange rate into another form of money, that's in my view a bank. And also a lot of shadow banks, they offer those kind of constructs. So when you offer that, then the question is, what is on your asset side of your balance sheet? So here are the stable coins on that side. On the other side, they have also assets. And quite often when you go and look in their annual reports, there is risk on the balance sheet. So you can have a bank run on stable coins, and that happened also last year a couple of times, but that risk is still there. So stable coins are quite often also fragile and should be, in my view, regulated as banks. And I think Bitcoin is the really exception. So this is the interesting part, so that you have a network, so there's no central counterparty. And they do not offer contractual liquidity. You can only trade Bitcoin on the market or buy it on the market. You can earn a little bit by mining, but the key thing is that you own it and you can sell it on the market. So there's a market price for Bitcoin and there's no contractual liquidity. I cannot go to the issuer of Bitcoin and exchange it into something. And this is in a way a good thing. So it is a private network, but I think it can offer to some extent a safe alternative. And I think so when you diversify, you invest in more things, then definitely invest also a little bit in crypto if you want to protect your purchasing power. And maybe it can also have a disciplining effect on the current system. So in a way, you can already argue that is already happening, so that all those central banks are investigating central bank digital currency is also influenced by this growth of private currencies and the possibility that you indeed can have something safe, something that is not runnable. That's the essence. And why should it not be a public variant? So I think Bitcoin has already a disciplining effect in the world of IDs, and maybe also in practice, because people, when there are a lot of problems in the banking system, say they move a part of their wealth to Bitcoin. Questions?
Two questions. One is, I mean, you say now there's two models, but isn't there an intermediate model possible, which we also have in the water sector, in the drinking water sector, where you have private companies by basically delivering the drinking water, but they're capped. They cannot make more than certain profits, and also their prices are in some way capped based on cost pricing. Couldn't you have a kind of semi-public banks, safe banks, but where the profits are also capped? But because it's also weird that something which we really need, exchange of money, that banks can make huge profits on this. That is weird. I mean, in the water sector, we don't accept that, which is also a kind of public good, water, kind of. Mm-hmm. So I would say there is a third model possible, like definitely. What we have in the water sector. Yeah. Basically fully regulated semi-public private companies and do that especially for the deposit type of banks. And the other question I have, we already have a new system in Indonesia. It's called Kinesis. And Kinesis is a backed up system with gold. It's digital money, KAU and KAGS, but it's backed by real gold because people can only buy these cryptocurrencies when they buy gold and put it in a deposit in the Kinesis platform, and they ensure that there's real gold behind it. So that experiment, which is now ongoing in Indonesia, and even government officials can be paid by that system, their salaries, is a very interesting new system which might challenge the whole banking system right there in Indonesia. I mean, it's ongoing. So I think we can learn a lot of important lessons from that.
No, there are definitely a lot of interesting experiments going on. So there I totally agree. And so the second question, so that's again a question about the backing of this currency. Should it be backed, yes or no? And I think so the main thing when you want to have stable money is that there is good governance and that rules are time consistent. So with the gold standard, it was of course the problem that they all the time changed the exchange rate. And so the key of every monetary system is that it's time consistent and that there is good governance, so meaning in this case good regulations, good rules, and on the other hand good technology. So this would be with those central bank digital currencies, so that is time consistent. That's I think the most fundamental mental thing, so that when there are rules that people are sure that the rules will be accepted. And when we look at the history of money in banking, then quite often when there is a crisis they change the rules. So it happened quite recently, quite significantly with this insuring uninsured deposits. And your first question about, so there are broadly two ways forward, and indeed there are all models that combine those two things. And one key thing, if you think about the central bank digital currency, is how to bring it into circulation. So one model would be that indeed, so the monetary authority decides we need to have more public money, we give it to the government and they spend it into circulation. One other model would indeed be that you ask financial institutions, private financial institutions, to do it for you, to lend it into circulation. That could also be the case. And then you have more credit auctions. There are also quite good proposals for us that you auction the right of money creation to private institutions, and that is an income for the state. And the main advantage, so what those financial institutions would then bring into circulation is real money, and not those contractual money in those proposals. But there are many proposals, there's really debate going on how to improve this system. And unfortunately, so in the world of ideas, there's a lot happening. But when you go to the politicians, they are still this mindset of protect, constraining, and on really with small steps. So increase capital rates from 8 till 9. And then that's really the question. So does that really make the system better, safer? Which problems do we solve there? But maybe coming years, there will be a breakthrough. Let's see. Yeah, so when a big bank falls, so we have seen it with Credit Suisse, so then it becomes politics. So when there is a risk that the big bank will fail, then politicians will support it. And within the current system is justified, I think. So there are good reasons that you do it in the current system because of this contagion and that you don't want the collapse of the whole system. So then it becomes political economy. And this is why those proposals of central bank digital currency, when they would have been implemented now already, so when there would have been a safe alternative, it would just say, so Credit Suisse, all the bank deposits would just transfer to the Swiss public digital currency. And then with all the assets of the bank, we try to sell it on the market and that's the income. That could have been a reasonable way forward. But as long as you don't have it, you can also not discuss this option. And then you have to save those banks. Other questions there in the back?
It's just a point of view questions. Do you think the layer system right now is good, or you think that maybe the decentralizing bank will be a better idea for the banking system right now?
Again?
Because now there's a tier and a layer system for banking, and then you also say the alternative of having a decentralized banking. What do you think will be better? Because in my point of view, in the decentralized banking, it's going to be a little bit bigger risk than the layer right now, but I'm not so sure about the point of view of yours, so I was just want to listen about that.
Yeah, so in the second proposal, there is a kind of paradox. On the one hand, say you want to centralize it, so the public monetary system is centralized, and you want to liberalize or privatize the banking system, to decentralize it, to make it more diverse, more variety. So like the Netherlands is in a way a very good example. So we have 3 big banks, about 80 or 85% market share. Then, of course, there are smaller banks and there are non-bank financial institutions, but those non-bank financial institutions like credit unions are really small. And if you would say, so we have a public money system, safe, you cannot have a bank run on that, we abolish those safety nets for those private banks, we make regulation much more easy, then it's much more easy for other companies to enter the market. There will be more competition. They will have a wider variety of mutual funds, investment funds, credit unions. That will give lower price, and then you have both. So you have a safe public money system on the one hand, and on the other hand you will have a really diverse financial system. And the question is then, should you call those institutions banks? That's about the definition question. So how I define banks in my thesis is that they create indeed those money claims, and that they offer contractual liquidity. And when you are not doing that, so you issue shares, or like credit unions, you issue bonds, you fund yourself differently. Then you maybe have a system without banks. But then the question is that bad? And there are quite some proposals that indeed go towards the end of this money issuing claims. And also there you have to look at those digital technologies. So on the one hand, banking is becoming more and more fragile because digital bank runs are much more easy to execute in the digital age. And on the other hand, so those other forms of liquidity, so this public money is a new form of liquidity. You can an inherent money in a digital form. You cannot ever run on it. It's only possible in a digital age. So you could not have implemented it 3 decades ago. And market liquidity. So we digitalized equity market shares last decade. So 100% of equity markets are today digital. Bond markets about 35-40%. Is more easy to do because bonds are much more diverse. But also increasingly, you just can trade all kind of bonds all over the world with your phone. And then, of course, those crypto markets, they are completely digital from the beginning. So on the one hand, we have a real increase of market liquidity. We can access it with our phone. We could implement this public money, this public digital inherent liquidity, that safety. And if you combine those things, when it's big enough, do we really need this risky construct of contractual liquidity? What has in history done something good, so it's not per definition a bad thing. But the disadvantage of a system based on its contractual liquidity is that you will always have sometimes bank runs, and there is a huge need for all the time government protections on the one hand, and on the other hand, those regulations. And that is hard to understand in the market economy. So we can reform, in my view, with the help of digital technologies, towards a monetary system that is much more in line with principles of market economies. And in the end, there you will have the better forms of money. There you will have also the better, the better financial institutions in the end. And that's so. Back to your question. So that's on the one hand is public, and on the other end is this market part. And I think when you combine both, then you go really towards a different system.
Hi. Sorry. Hi. There's a very famous song by 50s, I think from the 50s, by American folk singer Pete Seeger, and he sang, "The banks are made of marble with a guard at every door," which showed that in these times, I think, the idea of a bank was very politicized. And I noticed that you mentioned then it becomes political economy. But do you think that asking the question, how do we see the role of the economy and the government and the market before we ask these questions about how do we want to design our system, can it serve us better than asking us now when there's a problem, what do we want to do, where do we want to go?
No, definitely. So this is the main weakness. So I discussed it with plenty of politicians last decade. So, and they don't have a real view or vision about how the system should look like in a digital age. So, and when you don't know which direction it has to go, then the only thing you can do is react. So you see a very reactive approach. So when there is something happening, then they do those kind of things. Instead of saying what we think in the long term is needed, is that, and because that's our vision, we implement those steps. So I totally agree. It would be much better to say in the beginning, or debate it from the beginning, or in every debate, to emphasize in which direction the system should move. Yes.
As you may notice, we are going over our time. I'm not sure, Martijn, if you have some time left.
I have some time left, yes.
So everybody who needs to go, please do so. Everybody who wants to stay and ask some more questions, you can do that too. I have a question, Martijn. I believe, and I'm not sure if my numbers are correct, but in the past year since Corona, 20% of the money supply, or the money supply grew by about 20%. And then now we have the Fed raising their rates, and the ECB is doing the same. In your personal opinion, how much do you think is that the cause of the banking crisis, raising the rates, and is decreasing money supply, is that part of it too? And what's the future? What's the effect on cryptocurrencies? Can you elaborate on that?
So with the Silicon Valley Bank, it's definitely the case that those rising interest rates disrupted the business model. So, and they had just not expected that it would happen. So they didn't ensure it. They were not managing those risks. So in that case, it was definitely it has been definitely the case. And in general, what I think that will happen in the European Union, indeed, that the process will it is a very slow bank run. I think that will happen coming decade. So when you look so when you look at the interest on your bank account, so it's still very low. So more and more people will go to look for alternatives or abroad, or they will buy all kind of short-term bonds that are tradable on markets, or they will go to money market funds. So where you get a higher return, and that means so more and more bank money is flowing out of banks. So that's happening, and banks have long-term assets. So in a way, the same problem with as the Silicon Valley Bank, all Dutch and German banks. So mortgages with really low return. So they've given mortgages with people with 3% interest rate. So when there are much better mortgages available in the market, people are not interested to buy those mortgages anymore. So when there is a bank run, it's very hard for them to sell them. And how that will evolve in the future, that also depends how high the interest rate will come. But that the business model is under pressure, and there is in my view, there is continuous state support for the business model of banks. So when there is a problem, central banks start to intervene. How that will end is really, really difficult to explain. So I quite often give the example. So when you would have said to a kind of monetary economist in 2010 or 2005 that central banks would do what they are doing today, they would have said that you are crazy, that you really don't understand the basics of monetary economy. That will never happen. So this massive quantitative easing was really outside. When you said that you're so far outside of mainstream monetary economics. And so it is happening, and in that sense, all the time, the unexpected is also there happening. And so there again, so this is the view about the future. Also there, I think in a way that so for central banks within their mandate, they can also do what they do. So they try to stabilize the current system within their mandate, but the problem is their mandate, and then it's again a political topic. So central bank, of course, politicians should be brave enough to change those mandates of central banks, to just give them different monetary policy instruments. So one very easy example. So when we would have all an account at the Central Monetary Authority, say the ECB. So the current monetary instruments is the interest rates on central bank reserves. We don't have accounts at the central bank, there are only commercial banks. So there is a massive amount of reserves in the system. So they are now making a lot of money, really more than 100 billion only in the Eurozone this year. Banks. So there is a flow from central banks to commercial banks. This is because that's their instrument. And then central bankers hope that they give this income to depositors, so that they also increase the interest rate on our accounts at the banks. But they are not doing it in practice, or it goes very slowly. That's the first instrument they have. And the second is this quantitative easing. So this is buying assets on financial markets. So who own those assets? Now that are big companies or large investment firms, rich people. So they buy those financial assets of those people, and it doesn't really reach the real economy or the bottom of society. So when we would have had all an account at the central bank and we need more money into circulation, just add all accounts with 10. They have a central instrument, but it is brought into circulation on the lowest, most decentral level. And there have been economists already for decades proposing this instrument, but it's not possible, or it's highly questionable if it's possible within the current mandate. And then again, it's a question, so are politicians brave enough? Are they willing to change those mandates of central bank and really the design of the system? We are not there yet.
Anyone else?
Yes, currently on WikiLeaks there was a news report that the Fed should have about 1% of the Bitcoin circulating supply. We're now about 6 billion, I believe. Do you see them holding that or selling it to kind of manipulate the cryptocurrency market?
That's also a very difficult question. The question is, why do they have it? That's then and that's that's guessing. So in a way, you can also understand that central banks are also increasingly diversifying. So they want to have different assets on the balance sheets, so that then in the case one market collapse, they are kind of insured, and maybe they just use it as a hedge. But there are also some rumors. I'm also not sure about those fallen banks in the US that they. Why didn't the Fed rescue those banks? Because they just didn't like cryptocurrencies, some people say. So but those kind of things are so hard to assess if you're not at those tables. So I'm not sure. What do you think yourself? That's maybe the good question.
I think they've been accumulating for quite some time already. So I think they might be holding it also for the long term. But it's a guessing work.
It's a hedge. Then it is a hedge.
Like a future gold.
Yeah, could be. Other questions?
You have pointed out that whatever central authority should take care of our deposits should be properly governed, which I share that opinion. But as you also rightfully mentioned, is that whenever there's a crisis, the rules change. So how do we ensure that whatever governance we establish actually stays intact?
Yeah, that's a very good question. So yesterday I proposed to another economist that we should research the history of the cadastre. It's like in the Netherlands where all the real estate is registered. It's already there for, I don't know even how long, but it functions. All people trust it. There are no questions about it. And in a way you can imagine that in the digital age, so when Switzerland, the Netherlands, other countries would offer a digital safe where you can just store digital money to their citizens. It can be really something really valuable, and then we should learn lessons of other systems. I think that function really for a long-term time consistent. How is that organized? And you could argue so maybe there should indeed be a rule that there is a kind of the money supply could increase every year between 2 and 5%. And if central bankers want to create more money, then really there should be an emergency, and the parliament should vote for it with 75% of the vote. So in the case of a war, you can of course understand that there are some things happen that indeed it doesn't matter if you have inflation, we have first to win the war. So that's quite clear. So I think then you should really also discuss, debate, develop those kind of rules that only in a really emergency case, and this is of course also the story of those central banks. With this quantitative easing, they in the beginning said we do it only in the fall of an emergency. So after the crisis of 2008 case, okay, this was an emergency case, but then it happened again and again, it went bigger and bigger. So it was all the time emergency. So it's just no one can believe their story anymore. And when you change the rules, then indeed it should be, I think, those kind of rules you need. So a limit on the amount, and when there is a kind of exception, then it should also be kind of democratic decision behind it. So not central bankers can say themselves, so now we are going further. Yeah, that's for now, I would say.
Yes, you were talking about the risks containing because of stable coins. And my question is that I've been exploring like documents of the Bank of International Settlements, and they were thinking about putting cryptocurrencies and crypto assets and stable coins within the assets of a bank. And they were exploring what risk-weighted assets they should put on a particular asset, what is crypto. But that will raise a lot of risk for the crypto sector itself, because what you do is actually you put cryptocurrencies on a bank's balance sheet that inherently is weak because fractional banking, and when they almost fall down, they will sell off those cryptocurrency and create turmoil within the crypto market, like you've seen last week or 2 weeks ago with USDC. What's your opinion on this cross-sectoral applying of a risk?
Yeah, so that's also, I think, in the digital world is also increasing that everything is interconnected. And that it's very easy indeed not only to have a digital bank run, but to crash all kinds of market because there's just a rumor going somewhere on the internet. And so I argue that Bitcoin has a disciplining effect. But indeed, when there's a full financial crisis, then the question is what is going to happen? When central banks do not intervene, then maybe even also those markets really go down because everyone wants to sell all kind of assets. So this interconnections, this is indeed, I think, also increasingly problematic, and also therefore I think so again, so that you just say we have a public liquidity in society. That is what we organize. Out of our democracy, that's where we can take responsibility for. And outside that, that's also, in a market economy, there are private risks, and then you should make those risks transparent. So indeed, when people say a stablecoin, have a look at the balance sheet, so those kind of things, and the consumer protection, that's of course also very important, but this is also part of a market economy. And indeed, sometimes things should also fail. And you can only allow that when you have a kind of safe core, and this, in my view, could be this public liquidity.
In general, the risks are borne on the like the shareholders and the obligation holders, and the regulation, the CRD and the CRR are also like saying when a bank's almost falling down, those people should borne the risk of this bank falling down, and mostly the consumers who don't get the hit. But Silicon Valley was a different story because that was like more not really a quantitative risk, more a qualitative risk, in the sense that Silicon Valley is a big sector for the American people and the tech sector. It's much geopolitical in my opinion. But that is really hard to like assess what you have to do to protect like the whole sector.
Yes. No. Yes. Yeah. That's how it is. Yeah. It is in that sense. It is also very hard. And maybe this. So what we try to do now is to say we have systemically significant banks and banks that are not systemically significant. And we have also special resolution plans. So when something will happen, then we are going to take those steps. But in practice, you see, yeah, so it takes too much time. It just takes too much time. So people, so they know that the bank is going to collapse, and there's immediately a rumor all over the world that it will going to happen. So all people get worried about those, also about other banks, and then the regulators, are not. Yeah, clever not, or it's just too difficult to execute those special resolutions in the weekend. And because they fail, then they make everything systemically relevant. So then they change the system overnight, more or less. And indeed, so you could have said, so maybe they should have put those special resolution process or plans into practice, but it didn't happen in the US and it didn't happen in Switzerland. And the Swiss finance minister said last month it is impossible to do. Yeah, it is just too difficult. So all those different accounts, all those different bonds, all those difficult, and you have to do it really fast because otherwise people start to distrust the system.
Financial law. I do financial law, and I had like an exam banking law.
Yeah.
Like really, we went really extensively in the single resolution and CRR, no bailouts, and when you like see it in practice, how it involves all regulations, you just go vanish, gone.
Yeah, no, that's how it is.
It is really fragile and it's kind of funny.
It's not time consistent, and that's of course a very big problem.
Yes.
Thank you very much, Martijn. Thanks everyone for being here. I thought it was a very interesting and beautiful presentation.
Thank you.
And I hope to see you at one of our next events. So please, if you're interested, you can scan the QR code. We organize many different and very interesting events for you guys. Thank you.